Suppose a shopkeeper regularly sells his products to three of his customers, David, Anisha, and Nitin, on credit. Unless the shopkeeper maintained individual accounts in the name of David, Anisha, and Nitin, it would be impossible to find out how much money each one of them would have to pay at the end of the month. Similarly, the shopkeeper would not know how much electricity bill payment he made during the year if he does not maintain a separate account for electricity bill payment. The same is true for all other types of transactions that take place in the business. In order to group all transactions that took place with a particular person or item, businessmen prepare ledger accounts. Hello friends, welcome to Hamsa Accounting. In this video, we will learn about ledger accounts and how to write or post entries in a ledger. When a transaction takes place in a business, a voucher or a bill or a cash memo or something of similar nature is generated. These vouchers or bills or documents are called source documents and are regarded as evidence to the fact that a transaction has taken place. With the help of source documents, entries are made in journal. Items under specific heads are written in or posted into individual ledger accounts. The final balance of each ledger accounts are summarized to prepare a trial balance, which in turn forms the basis for preparing final accounts. Profit or loss account or income statement and balance sheet are collectively termed as final accounts. This is the process followed in maintaining accounts and determining the profit and loss of a business unit. In this video, we will learn about ledger accounts. Ledger accounts group all the items under a specific head in a single account. Since business typically deal with a variety of items such as fixed assets, debtors, expenses, etc., therefore multiple ledger accounts are opened for individual heads. Ledger is also referred to as the principal or main book of account. Let us now get familiar with format of ledger. A ledger as shown here has two sides, one on the left of the yellow vertical line and the other on the right side of the vertical yellow line. The yellow line shown here is only for easier understanding. In reality, no such line is needed. The four columns on the left side is marked for writing date, particulars, journal folio, and amount in figures. This side is used to write only debit transactions of a particular account. The account is named as machinery account for representation purpose only. Just like the left side, the right side also has the same four columns. The right side is used for writing credit transactions for a specific account. Just for representation purpose, an entry on the debit side is shown here as to bank account with the amount 2,25,000. This means the machinery account has been debited with rupees 2,25,000 because of a certain transaction. Always remember that the name of the account which is used to denote the name of ledger is never written on the particulars column of either debit side or credit side. So, we will never write to machinery account or by machinery account in either the debit side or the credit side of machinery ledger. On 31st/12/2022, the machinery account has been credited with rupees 30,000 because of depreciation. So, by depreciation account has been written on the credit side of this ledger. After totaling the higher of debit and credit side, the balancing figure is written as by balance CD, which represents the closing balance. This is done at the end of the accounting period. In the beginning of the new accounting period, the closing balance is transferred to the opposite side, which is referred to as the opening balance of the ledger. Having learnt about the meaning and format of ledger, let us now enter some transactions in ledger. Suppose these are the three transactions which took place for a business on a particular time period. First, commenced business with cash rupees 6 lakh. obtained bank loan rupees 2 lakh, purchased machinery with cash rupees 1 lakh. The first step is to write the journal entries for each of these three transactions. The journal entry for the first transaction is cash account debited to capital account, or cash account is debited and capital account is credited. For the second transaction, the journal is cash account debit to bank loan account, and the journal entry for the last transaction is machinery account debit to cash account, or machinery account is debited and cash account is credited. If you desire to know how journal entries are made, then please watch the videos on rules of debit and credit and journal entries. For these three transactions, you may have noticed that cash account appear in all the three journals. The business entity will find it difficult to tell how much cash balance is in hand because two transactions signifies increase in cash balances, while one, that is the third one, denotes decrease in cash balance. This problem for the business entity will keep on increasing when more transactions representing cash account occur in the days and weeks to come. To make things easier, it is advisable to make a separate account where only cash transactions will be recorded. So, it may create a separate ledger for cash and name it as cash account. Let us create a cash account in the form of a ledger. The first journal, if you recall, is cash account debit to capital account. Since cash account is debited in the journal, therefore we will write on the debit side. But we never mention cash under cash account. We will write the other side of the transaction. In this case, it is to capital account, and the amount was rupees 6 lakh. So we will write to capital account on the debit side of cash account or cash ledger. The second journal entry is cash account debit to bank loan account. Again, the cash account is debited in this transaction. So we will write on the debit side, but we will mention the other aspect of the transaction, which in this case is bank loan account for rupees 2 lakh. The third journal entry is machinery account debit to cash account. In this journal, cash account has been credited, so we will write the event on the credit side of cash account or cash ledger. But we do not mention the name of an account within that account. So we will write the other side of the transaction, which is buy machinery account. It is customary to write buy before the name of an account on the credit side, just as it is to write to on the debit side. As there are no additional entries for cash in the journal, so we can proceed towards totaling and balancing the ledger. On comparing the debit side amount with the credit side, it is evident that the total of debit side is more. Rupees 8 lakh on debit side and rupees 1 lakh on credit side. First, we shall take the total of the higher side and write the figure on the total place. Here, the higher total is rupees 8 lakh on the debit side. Then the same amount, rupees 8 lakh here, is written again on the other side. But we know that the total of credit side is only rupees 1 lakh. So we need to calculate the difference. If we calculate, it comes to rupees 7 lakh. That is rupees 8 lakh less rupees 1 lakh. So if we add rupees 7 lakh to rupees 1 lakh, the total of the credit side will also be rupees 8 lakh. This rupees 7 lakh is the balancing figure and is written as buy balance CD at the end of the accounting period. This same balancing figure is transferred to the opposite or here debit side in the beginning of the new accounting period. This is called the opening balance of ledger and is denoted as to balance BD. A pertinent point to remember is asset account will always have debit balance in the beginning of a new accounting period. So we just learned how to make entries in the ledger accounts. Out of the 3 journal entries in the example, we have already prepared cash account for recording all the entries pertaining to cash. Three more accounts or ledgers are needed. These are capital account, bank loan account, and machinery account. Let us now prepare the ledger for capital account. The journal for capital is cash account debit to capital account. The capital account is credited in the journal. So we will write on the credit side of the capital account or ledger as by cash account. Since there are no other entries concerning capital, we can close capital account by first writing the total amount. The higher total is on the credit side, so we will write rupees 6 lakh first on credit side. The same amount is also noted on the debit side, but no accounting entry has been made on the debit side. Thus, the balancing figure will be rupees 6 lakh itself. This closing balance is transferred to the opposite side to arrive at the opening balance for the next year. Capital account will always show a credit opening balance. Using the same procedure, bank loan account is prepared. Since bank loan is a liability, it will always show a credit balance. The only account or ledger that remains to be prepared from the example journals is machinery account. Using the procedure that we learned, we can prepare the same. Machinery account represents asset and asset will always show a debit opening balance. If you recall this illustration from a previous video, then you already know 5 classifications of accounts. Out of these, asset, liability and capital are called permanent ledger accounts because they have an opening balance, whereas expenses and income accounts are called temporary accounts because closing balances are transferred to profit and loss account. Asset account will always show a debit balance, whereas liability and capital will show credit balance as their opening balances. And as has been discussed earlier, the balances of expenses and income accounts are transferred to the profit and loss account, and these accounts are closed at the end of the year. The difference between permanent ledger accounts and temporary ledger accounts are given here for your benefit. Please go through these differences. I hope the meaning of ledger and the process followed to make the same is clear to you. Thanks for watching. Please like and share.